My name is Keith Singh, and I'll be presenting my thesis titled Machine Intelligent Forex Trading Using ForeX-TimeGANs. So the foreign exchange market is a global market that facilitates the exchange of national currencies. Currently, it is the largest and most liquid financial market, facilitating $6.6 trillion in trading volume. This high trading volume can be attributed to the fact that it is a decentralized global market. It provides 24-hour access. It offers high liquidity, a low transaction cost, and higher leverage. There are two schools of thought in the Forex price prediction field. The first school states that prices do not follow a random walk and that we can use machine learning models with historical prices to predict the exchange rates. The other school of thought states that prices do in fact display random walk characteristics, whereby the chance of the prices going up or down is 50%, therefore making Forex price prediction unachievable. Furthermore, within the school of thought, there's the efficient market hypothesis theory, which states that all market information has already been embedded into the price, and that any form of technical analysis using historical prices would be pointless and would not allow us to forecast prices. However, having reviewed numerous papers, authors do indeed show that neural networks and other deep learning architectures such as GANs are successful at predicting Forex prices. Therefore, as GANs and TimeGANs are a fairly new architecture with growing interest, we intend to use them to forecast the closing prices. Therefore, the research objective of this thesis is to propose a novel TimeGAN architecture design that can accurately forecast the closing prices for 1, 3, and 5 days in advance for any currencies. In achieving this research objective, we have made the following contributions to the field of the Forex price prediction. To successfully achieve the research objective, we have adopted the following methodology. We will first extract the data and conduct the following data pre-processing steps. With the processed data, we will then explore and implement various variants in the following architectures. Within the neural network architecture, we have implemented 4 baseline variants. Within the GAN architecture, we have implemented 9 variants. And within the TimeGAN architecture, we will implement 8 variants. The effectiveness of each variant will be assessed using these 4 common evaluation metrics. The model with the lowest error value is the model with the best forecasting ability, and is found to be the ForeX-TimeGAN model. We first selected currency pairs based on the turnover rate. These are the top 3 traded currency pairs. We then extracted their Forex prices from a reputable source. Daily data was selected over monthly or yearly data due to the numerous papers that have used daily data. Only data between the years of 2007 and 2021 was extracted due to the limited access of a free account. Although there are a multitude of factors that can affect the Forex prices, this thesis will forecast prices only using primitive features and technical indicators. With the extracted data, we then clean the data by replacing missing points, remove unwanted features, and remove the noise present in the data using moving averages. So these are some of the technical indicators that we've used. Moving average indicators are indicators that show the average price value for a specific time period. So assuming that the closing price at timestamp t is made up of 2 components, the trend at timestamp t and the noise at timestamp t. By taking the moving average, we can smoothen out the noise component. This can be seen on the graph on the right, that you can see that the closing price is very erratic. However, by taking simple moving averages between 10 to 50 days, you can see that the lines are much more smoother, which show the general trend of the price. Other technical indicators include volatility indicators and also momentum indicators. So after adding the technical indicators, we then split the data into 70% training and then 30% testing. It's important to take note that we did not shuffle the data before the split. This is so that we can retain the timestamp information. The training set is used to train the model, and the test set is used to assess the model's unbiased performance. So after splitting the data, we conducted feature scaling, which is deemed the most crucial data pre-processing step. It is found that machine learning algorithms do not perform well when features have different scales. In the example on the left, we can see that the number of rooms are in the tens range, but the house prices are in the millions range. And therefore, if we were to feed this data into the machine learning algorithm, higher weightage would be given to the house prices. We've used mean max scaling as it was the most popular method used in all the papers that were reviewed. And of course, after scaling, the values are between the range of 0 and 1. So after scaling the features, we then applied the window sliding method to create t-sized windows of data. A t-sized window denotes the look-back period that would be used by the models to learn from in order to forecast the closing prices. Through experiments, it is found that a t-sized window of 30 days produces the best results. So you can see here that big X1, that's the first window, has small x1 to all the way to small x30, where small xt denotes all the features ranging from 1 to n. And this window is then fed into the model for training purposes. And then the model predicts the closing price of the next day, which is yt plus 1. And this window then slides down by 1 timestamp and continues for the entire data set. So this thesis first explored and implemented these following standalone neural networks that have been widely used in the field. The results of these neural network models will be used as the baseline to compare the effectiveness of the GAN and the TimeGAN architecture at forecasting the closing price. So GANs is a reasonably new architecture in the deep learning space. So GANs consist of 2 neural networks, the generator and the discriminator, and they train like a zero-sum game. The generator G is a generative model that takes in a fixed length, randomly distributed vector Z as input, and it creates synthetic data that closely resembles the real data, which is enough to fool the discriminator. It does so by capturing essential features and the data distribution present in Z to produce the synthetic data. The discriminator, on the other hand, is like an adversary. It's a binary classifier that tries not to get tricked by distinguishing the real data from the synthetic data. So the real data and synthetic data is fed into the discriminator, and the discriminator aims to label the real data close to 1 and the synthetic data close to 0, which is fake. As you can see that both the generator and discriminator has opposite goals, and therefore they are trained separately. In the discriminator's training phase, the discriminator tries to maximize this loss function as seen over here. In the generator's training phase, the generator tries to minimize this loss function. So GANs have predominantly been used as a generative model for the task of image generation. However, transforming it to forecast Forex prices requires a little bit of creativity. As seen in the previous slide, we feed in random noise into the generator to generate synthetic data. But we feel that this method is incorrect as we're unable to ascertain the day that we are actually forecasting for. So instead of feeding in noise into the generator, we propose that we feed in the actual currency data into the generator. So let's assume that small xt represents all the features at time step t, and yt represents the closing prices at time step t. So we will feed in all the features of the previous 30 days from x1 to x30 over here into the generator to output y hat t plus 1, essentially generating the closing price of the 31st day. Along with that, we would also have a vector y, which contains the closing prices of all the previous 30 days, so y1 to yt. And what we will do is we would append y hat t plus 1 to this vector y, and we will label it as 0, which means that we're labeling it as fake. Why is because we are inputting y hat t plus 1, which is the generated data. So therefore, this entire set is fake. Along with this, we would also have another vector, y real, which essentially contains the closing prices from y1 to yt, but it also contains yt plus 1, essentially the actual price of the 31st day. And we will label this as 1, which means that it is real. And these two vectors, y fake and y real, are then fed into the discriminator to discriminate. Essentially, the discriminator would label it as 1 as real and 0 as fake. The training phase remains the same as the GAN mentioned previously. Using this design, we then incorporated the various neural networks highlighted in the previous chapter to generate 9 GAN variants. Essentially, we are using variations of the neural networks for the generator and the discriminator. So you can see over here that we have used GRU as the generator, GRU as the discriminator. Over here, we are using LSTM as the generator, but we're using CNN as the discriminator. And that's how we have attained the 9 variants. This slide shows the results of the various GAN variants that were experimented. We can see that GAN variants that use CNNs for the discriminator generally had lower error values. However, the best results were achieved by the GAN variant, which used CNNs for both the generator and discriminator, as it had the lowest error values. Therefore, it has the best forecasting abilities. These findings are pretty similar to the ones found by the author Staffini, who actually used CNNs for both the generator and discriminator and attained a lower RMSE value as compared to when she experimented with other neural networks for the generator and discriminator. TimeGANs. So GANs were primarily designed and optimized for generating images. However, some authors have enabled them to forecast prices by using methods as shown in the previous chapter on GANs. However, author Yun argues that despite their superior performance in predicting Forex prices, GANs cannot attend to temporal correlations that are unique to time series data. Their discriminator still does not incorporate the autoregressive prior, despite the simple improvements of attaching RNNs, LSTMs to the generator and discriminator. Furthermore, using a standard GAN loss function over a sequence of vectors may not be sufficient enough to ensure that the architecture captures the stepwise dependencies that are present in the training data. So therefore, Yun proposed the TimeGAN architecture that is designed to generate time series data. The author states that their time series generative model captures the distribution of the features not only at a single point like the standard GAN, but rather the complex dynamics of these features spread across time. And it's done so by incorporating 3 loss functions and an embedded network. And by doing so, they attend to temporal correlations, and the discriminator does incorporate the autoregressive prior. The TimeGAN model consists of 4 key components: the embedder, recovery, generator, and discriminator. The embedded and recovery components are part of the autoencoder network, while the generator and discriminator are part of the adversarial network. As highlighted earlier, that the latent data is shown to reduce noise and possesses better explanatory factors. Therefore, given that we have a vector that contains static and temporal features, the embedding function E takes the static and temporal features to their latent code. The recovery function R is then responsible for taking the static and temporal features in the latent code back to their feature representation. Unlike the conventional generator that produces the synthetic output in the feature space, the generator and the TimeGAN outputs in the latent space. The discriminator receives the static and temporal codes from the latent space and then conducts the usual classification task. The author focuses on the concept of joint training of the autoencoder and adversarial network, which is done for the following three loss functions. The first loss function is known as the reconstruction loss. And this loss is minimized to ensure that the reconstructed time series data from the latent space resembles the original data. The loss function optimizes the autoencoder network. The unsupervised loss is similar to the one that is found in standard GANs, and the supervised loss shows how well the generator can approximate the actual next time step in the latent space while receiving the encoded data from the prior sequence. And the joint training is done in three phases. In phase one, the autoencoder network is trained to optimize reconstruction ability. In phase two, the supervised loss is optimized. And finally, in phase three, all the four components are jointly trained. So let's have a look at how the training is done in three phases. In phase one, the autoencoder network in R is trained, minimizing the reconstruction loss. The embedder is fed with dataset X, which is the real sequence, and it outputs H. H is then fed into the recovery component to convert the embedded sequence into its feature space. In phase two, the supervised loss is minimized. This is done by feeding the loss function with the real latent embeddings H and the generated embeddings H hat. It's important to take note that the generator takes in a random vector as input to generate H hat. Finally, in phase three, all the three loss functions are minimized. The generated embeddings H hat and the real latent embeddings H are fed into the discriminator, similar to the conventional GANs for the classification task, where one is labeled for real and zero is labeled as fake. And with the trained model, we can input in a random vector that's of similar dimensions to the real sequence, and the model is able to generate synthetic time series data that ranges from t+1 to 2t for all the features. So as you can see here that the TimeGAN generated data presents the same issues that were present in the original GAN architecture, whereby they use a random sequence vector to generate real time series data, where the results follow the probability distribution of the original data, but does not accurately forecast the prices. Furthermore, it does not use the prior 30 days data to forecast the prices of 1, 3, and 5 days in advance. Therefore, it does not allow the trader to forecast correctly or be able to ascertain which day it's forecasting for. And therefore, we needed a new design that, that enables the TimeGAN architecture to forecast correctly. So therefore, we propose this novel TimeGAN design that enables the TimeGAN architecture to forecast the closing prices. It uses the same components, the generator, embedder, recovery, and discriminator, and the three loss functions as the original architecture. However, instead of feeding in the generator with a random sequence vector, we propose that we feed in the real sequence X to be fed into the generator, similar to the real sequence that's being fed into the embedder. The output of the embedder is H, whereas the output of the generator is labeled HF hat. Furthermore, we will also feed in XF into the embedder. XF is extracted using the Windows sliding method. And the main difference between X and XF is that if X is the previous 30 days data, then XF is the next 30 days data, because it ranges from XT+1 to X2T. Now, this architecture is trained in three phases. In phase one, the autoencoder is trained similar to the conventional TimeGAN design, where X is fed into the embedder and it outputs H, and then H is being fed into the recovery component whilst minimizing the reconstruction loss. In phase two, the supervisor loss is being fed with, instead of H and H hat, we're feeding in HF and HF hat. And this is so that the supervised loss minimizes the difference between the future time steps of interest. These are the future time steps of interest. In phase three, the training takes place for all the four components whilst minimizing three loss functions. However, the discriminator is being fed with data that's slightly different. We will first concatenate H and HF and label this entire vector as real. And we will concatenate H and HF hat and label this entire vector as fake. And we'll feed in these two vectors into the discriminator for the classification task, where one is labeled as real and zero is labeled as fake. And with this entire trained model, we can input any time sequence vector with a time step ranging from 1 to t, and it will yield a forecasted time series vector that ranges from t+1 to 2t for all the features from 1 to n. However, because we are only interested in the closing price feature, only one of the features, we can actually splice this vector to just attain the closing prices that range from t+1 to 2t. Essentially, we can forecast the closing prices for 30 days, and we can select the closing price of interest, whether it's the next day's closing price, the third day's closing price, or the fifth day's closing price, using this novel TimeGAN design. So using the novel TimeGAN design that was proposed in the previous slide, we implemented the following variants that use various neural networks for the four components: the generator, embedder, recovery, and discriminator. Implementations 6 to 9 use the exact same design of the top 4 performing GAN variants, and this design is being implemented onto the novel TimeGAN design. In doing so, we're able to ascertain whether the TimeGAN architecture actually performs better than the GAN architecture. And also, furthermore, with their exceptional pattern extraction abilities, we then implemented very state-of-the-art 2D CNNs in implementations 10 to 13. Now we will compare and analyze the performance differences between the novel TimeGAN architecture versus the GAN architecture. As you can see here, the TimeGANs with balanced learning abilities, that means to say that it uses the same type of layer, depth, and has the same number of trainable parameters for all its components, it actually outperformed the GAN architecture. We can see here that when the GAN architecture uses CNNs and GRUs for all its components, it actually performed much better than the GAN that used CNNs and GRUs for all its components. However, when the learning was skewed, whereby the TimeGAN uses GRU or LSTMs for 3 of its components and CNNs for only 1 of its components, it actually performed worse than compared to the GAN that used a GRU or LSTM for its generator and CNNs just for its discriminator. It also can be seen here that CNNs actually performed much better at extracting features from the time series data. Both GANs and TimeGANs outperformed all the other variations. So that means to say that CNNs are better at extracting features. Now we will compare the performance differences between your 1D CNN TimeGAN versus the ForeX-TimeGAN, which uses 2D CNNs for all its components. As you can see here that the error values have decreased significantly for the ForeX-TimeGAN. Therefore, by switching its layers from 1D CNNs to 2D CNNs, the architecture is better able to extract patterns from the data. The reason for this superior extraction ability is because 2D CNNs allow the kernel to move in 2 directions to extract patterns, versus a 1D CNN which only allows the kernel to move in 1 direction. As you can see over here, the ForeX-TimeGAN is able to forecast prices more accurately when the prices are highly volatile. As you can see in the circle over here, the prices, the predicted prices closely resemble the real prices, as versus the 1D CNN TimeGAN, the prices are much further away from the predicted price, from the real prices. With the exceptional performance of the ForeX-TimeGAN that uses 2D CNNs for all its components, we wish to further deepen the architecture by applying state-of-the-art 2D CNNs onto the novel TimeGAN architecture. However, results show that these deeper architectures were unable to outperform the shallower ForeX-TimeGAN. Therefore, an increase in the depth of the TimeGAN model using 2D CNNs did not improve the results. In fact, it is found that increasing the depth can lead to the issue of vanishing and exploding gradients and the issue of overfitting. VGG16 TimeGAN, which had the highest error values, was found to suffer from the issue of vanishing and exploding gradients, as it was a sequential model that had no mechanisms to control the issue. ResNet in 18 and ExceptionNet solved the issue of vanishing and exploding gradients, but still suffer from the issue of overfitting, as we are training a fairly small data set on a highly complex model that has over millions of trainable parameters. Similar findings were found by authors which trained small data sets on fairly deep 2D CNN architectures such as AlexNet. We then ran the best performing variants of each architecture on the 3 currency pairs. In doing so, we validate the robustness of the ForeX-TimeGAN to outperform all other models in forecasting the closing price for any currency pair. So for the Euro-USD currency pair, out of the 3 architectures, the ForeX-TimeGAN architecture performs the best at forecasting the closing prices 1, 3, and 5 days in advance. It attains the lowest error values. Furthermore, a positive correlation was observed between the forecasting days and the error values. Furthermore, it is evident that the architectures that incorporated CNNs performed much better than architectures that did not. The reasons for that is because the data set that we have fed into the architecture fulfills the 2 key assumptions of CNNs, allowing them to work effectively. Furthermore, authors have also found that CNNs are generally much better at extracting patterns from time series data than as compared to other neural networks. However, for the USD-Japanese yen currency pair, the ForeX-TimeGAN architecture performs the best at only forecasting the closing price 1 day in advance, as it attains the lowest error values for that day, but is unable to forecast accurately for days 3 and 5. Again, the CNN GAN variant achieves the lowest error values for days 3 and 5. Again, it can be observed that architectures that incorporated CNN layers generally performed much better than architectures that did not. Also, a positive correlation between the forecasting days and error values is difficult to ascertain from this currency pair. Finally, for the GBP-USD currency pair, it is evident that the ForeX-TimeGAN architecture again outperforms all other architectures at forecasting the closing price for 1 day in advance, as it achieves the lowest error values. However, it's unable to forecast days 3 and 5 accurately, as error values are a little bit higher. CNN GAN variants actually, in fact, have a better accuracy at forecasting days 3 and 5 for this particular currency pair. Again, it can be observed that architectures that incorporated CNN layers generally performed much better than architectures that did not, further validating the choice of using CNNs for the TimeGAN architecture. To conclude, we've presented a novel design of the TimeGAN architecture that enables it to forecast prices using the previous T days worth of data. We've also presented the robust ForeX-TimeGAN, which uses this novel design, which allows a trader to accurately forecast the closing prices 1 day in advance for any currency pair. Furthermore, this model outperforms all other GAN and neural network variants. Finally, we're able to provide the code for traders to utilize this model to aid them in forecasting the Forex prices. Thank you.